Recording in progress.
All right, good morning, everybody. It's Friday. We made it. The Fed has managed to synchronize their message, finally. So what's going on now is they're getting that hawkish message through. And now there's the nuanced difference of what a pivot is. You know, we went through this phase in 2021 where they were using that language, thinking about, having a discussion about maybe doing something like a rate hike or whatever, right? Using that kind of really just asinine, stupid phrasing, right? So now it's this idea of a pivot and what a pivot means. For some people, the pivot means, well, they're no longer raising rates. That would be a pivot, that they are going to pause in their rate hiking cycle. To other institutions or other people, a pivot would be not just when they stop raising rates, but when they actually start cutting rates. So you're going to begin to hear more about what a pivot means and who's speaking when they're saying that. So kind of pay attention a little bit to which speaker is being questioned and what language they're using. The consensus yesterday was that there would be no rate cuts in 2023, period. End of story. But they might slow the pace, which has also been put on the table for a pivot. Oh, you slowed in your rate hikes. You're pivoting away from the 75 basis points per hiking cycle. And if you look at the Fed Fund futures probability, you can kind of see that adjustment coming in. Near the first week of September, there was an idea that by February 1st, we would be sitting at around a 3.75, and that would be after all of the hikes through November and December. And of course, at the time, the September was still on the table, right? So that would have been 3 rate hikes that got us to 3.75, possibly even all the way down to 3.75. And that was the highest probability at the time. Now, all of those are off the table, and the highest probability is that by the 1st of February, we'll be sitting somewhere around 4.5. Well, we are currently sitting at 3, and there are 2 cycles before we get to the February 1, right? So if you add, or I should say divide, from where we are at 3 to 4.75, try to figure out, okay, well, what's the rate hikes between now and then? November is still pricing in a 75 basis point rate hike going from a 3 to a 3.75. That has the highest probability right now with a 72%. Going from that, at 3.75, getting another rate hike in December, which would take us from 3.75 to 4.25. That'd be a 50 basis point rate hike. That has the highest probability at the moment for December. And then getting from 425 to 450, here in February. So they're looking at a 75, a 50, and then a 25 basis point rate hike in that order. So that's what you're going to want to be listening for during all of these discussions, and you see them popping up, what they talk about on Finance Juice, looking for anything that says they're going to continue to hit us with 75s without evaluating anything, right? If they mention or imply in any way that they're on some kind of autopilot, oh boy, this market's going to just shake it loose. The market doesn't want to hear that. Every time the Fed ever says anything about we're just going to run it on autopilot, everything goes straight to hell. They want to hear that the Fed is evaluating every cycle independently and making an informed decision about what they're going to do at this particular cycle. What they don't want to hear is, well, we're just going to set it on autopilot. So be listening for that. And then on a pivot, make sure that they clarify what they mean as a pivot. Is it that they're slowing their rate hikes, that they're going to not hit us with a hike but not cut, or that they're going to start cut? That's three, and I believe there's one more definition of a pivot. This morning it's all about the numbers. This is one of the two main economic numbers that are going to really drive the November FOMC meeting. If the job numbers today come in line, then everybody's just going to shrug and start focusing on econ next week. All right, there's one more economic event on the table of importance. So if this one doesn't rattle the market, then next week, which means today, could be an absolute dud. If the numbers today do not give some kind of fireball outcome, and we don't make that explosive move in one direction or another, we're going to very likely just hold the line. That'll get us in the next week. That'll line us up for the econ over there. We're still in the bad is good phase. So the market wants to see bad job numbers, higher unemployment, slowing economic growth. They want to see that the Fed is accomplishing something with all of these rate hikes. So a bad employment number today will be good. We're very likely going to see the market make moves to the upside. And good job numbers today, if hiring is still strong, if unemployment is still low, that's going to show the Fed is not accomplishing their goal. They're not dampening down this, quote, robust economy, and that they've still got a long ways to go in their hiking cycle. And the market's not going to like that. That good news is going to be disappointing to the market, and we're going to go down. Right? So now you've got some structure, and I don't know, is it really going to change what you do today, knowing now what the market needs to see? No, because by the time the market opens, all of this data will already be out. We're either going to still be sitting right where we are right now, or we're going to be ripping to the upside or tumbling down through the bottom of the marketplace. So, the why behind it doesn't really matter when, it's just going to go. It's kind of that old joke about where does a elephant sit? Wherever the hell it wants, right? What are you going to do, stop it? We do have more Fed speakers on the agenda today. And then we also have these economic events today. So we got the employment situation at 8:30. We have inventories at 10 a.m., which I've always found this one to be insightful. I like to go in and really dig down into this report. The rig count, which I worked on drilling rigs for 20 years, and most of the time you don't see a fleet just taken off the board or brought online, honestly, unless it's like the new flex rigs that came out. So this number isn't likely to change on a week-to-week basis, and if it does, it's by a couple of numbers, right? 2 or 3 rigs come online or go offline. And then the consumer credit, in the grand scheme of things, if the market didn't already have something to focus on today, this possibly could have some impact, but it's all about the jobs today, right? So I think that's going to just line us up. So with that in mind, really kind of consider what would bad look like, right? If we were to just tank today, what would that look like? Or if we exploded? An average move in the ES is around 1.5% in or 1% in a good normal bullish market, right? In a bullish market, we don't move very far on a day-to-day basis. In a bearish market, when we've got a higher volatility, we've got an average daily range of about 2.5%. So if 2.5% is average, and we're thinking today could give us an above average move, what is an above average move? 4.25. We've seen a lot of those recently, right? Or at least in 2022, we've had a number of 4% moves. So a 4% move today would not be out of line, right? And if we take that 4% from the close of yesterday, that would put us at 3,900 to the upside. So now we've got a benchmark. And when we talk about going to a gas station and buying a lottery ticket, one of those little scratch lottos, the reason that you have a chance to win $1 million and only risk the $2 that you spent to buy a lottery ticket, you're risking $2 to make $1 million. Doesn't that sound great? The only reason that the cost is so low is because your chance of actually winning is a snowball's chance in hell. Right? It's a YOLO. You only live once. Spend your $2. See if you win the lottery. Putting a butterfly on at 3,900 would be just like that. It would be really, really cheap. Probably pick it up for 1 or 2 pennies. And if it hits, if we pin there today, that $2 butterfly could very well make you $200 today. Take the same thing in the other direction. A 4% move would put us right down to 3,600. And if you were to put a butterfly down there, it would probably cost you 1 or 2 pennies. Believe it or not, you could put both of these on. Now you've got a total of what, $5 at risk, maybe at most. If neither one of them hit, you're going to lose $5. You can't get a coffee at McDonald's for $5 anymore, right? So I mean, are you really worried about, oh, I had a losing trade? So what? It's $5. You'll spend more in commissions than you'll spend likely in the risk, right? Those are the outliers. The other outlier is right where we are. Remember, we have a day today where we could absolutely do nothing. And the idea behind this is that one of them might hit. Now, just to be fair and honest, all 3 could lose. That's the nature of trading, right? Seriously, all 3 of these could lose. There's no guarantee that you're going to get one of them right. If you skip the one in the middle and you keep the 2 outside ones, you can actually rip them apart and turn 2 butterflies into an iron condor. So if halfway through the day you realize that we're not actually going anywhere, turn those 2 butterflies into an iron condor. You'll make enough money back from that to pay off the commissions on the butterflies that you made, and it's a scratch for a break even on the day. That's pretty cool, right? Don't attempt to do that if you are under $25,000 though, because it's going to cost you a lot of day trades to get that done. Every one of these that we're talking about is a day trade. You're not going to want to put these on for like Monday. So, if you do this, that's 3 trades. That's PDT right there. So just, keep that in mind. So 3,600 to the downside, 3,900 to the upside. That would be within our boundaries of what we could do today if things get out of control. The 3,600 is where we started the week. We ended last week down at 3,608. Right around in there. Came into Sunday or Monday underneath 36 and then rallied up out of it. So we would basically have a doji week. It is Friday, so one of the things that we want to do is kind of get a gauge or a feel for next week. It appears that volatility is expected to be less next week, right? The wife's birthday is next week. Yay! So lowered volatility, but I believe it's lowered volatility because there are less trading days next week, right? And there's a holiday next week on Monday, I believe. Certainly something to look into. All right, we have every expectation of lowered volume this morning because everybody's holding their breath waiting on the numbers. And even though the volume is a little light, it's still above 100K, so well within the boundaries of normal, and that's all we use this for, right? So we turn it off afterwards, get that real estate back. We've been sideways all night, makes perfect sense. We did have a little bit of a move through the kill zone, but only right back up to where we came from. Right, so basically nothing, like a hamster on the wheel, just running in circles, going nowhere. Once these numbers come out, remember they could be in line. They could be right where the estimates said we would be, and we get no real big reaction out of the market. That's not what I expect, but it's certainly on the table. So once we get the numbers, we're going to start making the move. There's really not a lot to game out here, pivot-wise, because if they're good, we're just going to explode, right? And, well, yeah, if they missed estimates, we're going to move one way or the other. I think what would be more valuable or more useful would be to kind of game out how long do we think it would last and what else could we trade with it, right? So in that upward move, say the numbers are bad job numbers and we do start making that move to the upside. How far up are we going to go, say, between now and November 2? And is it going to be another reset like we had, say, from July and August, that nice little dead cat bounce rally up into August where we hit the 200 period moving average? Is it going to be like that? Or is it going to be more short term like that May rally, that lasted like a week? What we know for certain is that we won't breach 4,300. I mean, that's basically off the table. We're very unlikely to make it beyond, say, the 200 period moving average and stick it above it for any long period of time. So by the end of today, if it's really good numbers, if it's numbers that make us move up, and we do make that explosive move to 39 or maybe even 4,000 by Monday or Tuesday, consider adding a new short call in the futures, right? I've been selling options on the futures, kind of make some money because there's just not a whole lot of really great stuff to trade in a swing trade right now. So you could kind of add that. And remember, we're still in sell to rip mode. So if we do rip to the upside today, going to be looking for new entries to short Apple again, short Tesla again, Nvidia, all of them, right? Anything that hasn't just absolutely crashed and burned. Whatever we get today, it needs to stick, right? So that we can have a reasonably decent trading day. So when you're going through the list after we get the report and we start making a move, really kind of game out what can I do to make money today in that move? If it's going to stick it and run all day, what kind of trades do I have on the table? Well, it's Friday, so you got 0 days across the board. You can basically do a 0 day in anything that has weekly options today. So there's that. And that's enough to pay the bills right there. Just those 0 days alone. You're going to want to see a high correlation coefficient. So watch the advanced decline. If we're bullish today, we should be pegged out across the top, sitting very close to 100. And if we're bearish, we should be sitting close to minus 100. We don't want to see what we had yesterday, a lot of this choppy, sideways, wishy-washy kind of market. It needs to pick a direction and go. Now, if you go back and look at where we've had these explosive moves in the pre-market, right, from jobs or CPI, PPI, whatever, the concern is that we're going to get some kind of mean reversion play, that it makes a really big move in the pre-market, we come into the open, and then it just turns around and dumps all the way back down again. So that's absolutely a concern. So kind of game this out. If we make that run to the upside, look for a rejection point across yesterday's high. That would be bullish until, right? And we've seen the market do this many times before, so it's well within lines. Kind of sucks everybody in. It's making that move to the upside. We're all excited about it. Tags into yesterday's high or into the range that we've been focused on, and then that's where she dumps down. So certainly that's on the table. We'd want to do the same thing with a downside argument. That it makes the move to the downside today, bounces off, say, a major pivot point. As we come into the open, it flips over and then runs the other way, just catching everybody off sides. There's been some really, really big SPX trades coming through. One of the posts that I seen used a phrase like, "We've never seen anything like it." And when you hear a market maker say, "I've never seen anything like it," it really has to make you step back and pause, right? Like, dang, how big was it? And one of the dates was actually really close. It makes sense when it's really big, but it's really far out in time. All right, that's not that bad. But one of these was at the end of October. And, in the grand scheme of things, if you're dropping billions of dollars on the table in a short duration trade, goodness. $10-day, 30-minute volume profile. We are in the shallow area. And if we make that move to the downside, we're very likely going to punch right through any cog lines or roundies or anything like that. Technical analysis and measuring a market's movement, its next impulse, its next leg, its pause area, how far it can go, none of that applies in a parabolic market, right? Technical analysis works on a market that's behaving efficiently. When it's extreme from fear, greed, economic news, technical analysis doesn't fit, right? Measured moves don't really apply. You can't trust them. And we very often overshoot any Fibonacci levels. So I definitely wouldn't lean too heavy into any form of analysis on destination or direction, other than just matching the extremes. What's a big move in the S&P? 4%, right? And of course, there's lock limits for a reason, because we not often, that's the wrong word, because we have moved, 5%, 6%, 7% in a day. It's why those lock limits exist. So 4 is not as far as we could go. It would just be what we would consider the beginning of extreme. The 5x5, we're still sitting within the zone. We don't have anything really here to focus on. And this untouched point of control from 36.67, if we were to make a move to the downside, I would not anticipate that this has enough structure behind it to be any form of a pivot or a support or anything like that, right? If the market goes down today, this is not likely to slow it down or stop it. Not in the first pass, anyways. We did have semiconductor news this morning, right? Had a couple of earnings, and they represented just about what we expected. The expectation is that we're going to see companies report more slowing growth, slowing sales, slowing everything. And that's the gist of what I caught this morning. We don't expect anything, to really be moving before the announcement. So it's no surprise that we don't have anything in here to really focus on. Gold is starting to move around a bit. But with gold, kind of keep in mind, gold doesn't trade by itself, and it very often is affected by other things, and it correlates with other things, like energy. I had a little something for energy. All right, oil and gold could start trading together higher. Energy prices rising is the big problem for monetary policies here and abroad, but especially in emerging markets, forcing local currencies lower and forcing the US dollar higher, which also causes these countries to sell US treasuries, bonds for US dollar as rates get bid up. Should that continue, and it will, if the US dollar Japan breaks out higher, that 145 that we've talked about, with US, China, and the EU acting slowly to raise rates high enough to stop the local currencies from collapsing. That would be the US dollar and the GDP US dollar, then the equity markets will be at the mercy of a leg down sooner rather than later, and gold will get supported. So if you're feeling frisky, you could aim for, say some longer dated gold calls. Just remember, you're probably a little early. So GOLD going to 1650 must close above the weekly. That would be GLD at above, say, 153. And just as a note, gold is used as a collateral, not just as sometimes currency, not sometimes as a commodity, and sometimes as a hedge. It's first and foremost collateral. Then it's a play on real rates. And then it's a hedge against monetary policy. Right? All of that in gold and oil combined with Japan getting above that 145 yesterday. And I was watching that like a slow motion NASCAR crash yesterday. And we got above it. And I was watching the dollar, and the dollar just kept on rising and kept on rising and kept on rising. And I didn't understand that. Right? Like, if Bank of Japan was going to come out and defend yesterday, that should have pushed the dollar down. And it didn't at the time. It just kept on going. But they did defend. You can see they're now back down into the red. And before they defended, the dollar did start to actually go down. Once they started to defend, or once that defense ended, well, the dollar is already bound back up. Trying to put all the pieces of the puzzle together, right? Understanding that it's not just about looking at one market and trading the things that you're seeing within that one market. All right, we still got 115 as the benchmark on the dollar. If we get above the 115, we're very likely going to go parabolic again in another leg up. So, seeing the dollar move any direction fast is a really bad thing. We want nice, clean, consistent price action, not big, monster, massive moves. Breaking below 110 in the dollar would probably be very good for the U.S. market, right? Seeing the S&P and NASDAQ continue to rise. If we maintain this sideways posture, I'm going to say that that's also going to be helpful for the market, right? Because that would imply the dollar is not putting any pressure on the market. And if we don't influence the market by an outside entity like the dollar, then the market's going to very likely revert to its natural state. And like I've said many times before, a market's natural state is to go up. That's what markets do. Unless there's something external pushing it down, a market just wants to go up. I was talking with somebody yesterday about energy, and they reminded me that the rest of us are not doing a very good job when we're talking about energy to make the distinction between crude oil and energy, quote, energy. So be careful with that, right? If you're reading an article or you're hearing somebody talk about, quote, energy, make sure you know specifically what the heck it is that they're referencing. Because energy can be solar, nuclear, oil, gas. It can be any number of things. Whereas crude is crude. So careful with that. We have, and I'm not a big fan of seasonal stuff, seasonality. It's not my forte in any stretch of the imagination. But there is a seasonally adjusted chart for crude that matches election cycles. It almost feels like one of those astrologer people. They're like, oh, the moon lined up with Uranus, and now we're getting some kind of, we're going to go to the upside in Bitcoin. Whatever. I don't put a lot of weight into that. But you can't argue when you run a seasonally adjusted back test and see that a market like energy tends to move after an election cycle, especially if it's been heavily manipulated before the cycle, like this year. They've been dumping strategic petroleum releases, SPRs, to artificially keep the gas pump prices down. It's nothing against this president. Every president does this, right? So I'm not picking sides or poking at anybody. Every president does this. But it artificially changes pump prices. And then after the election, when they no longer need to do that, then the prices go where they naturally would be. And of course, then the government has to restockpile those strategic stockpiles. So there'll be buyers. And that adds to the buying, right? Something to think about. But that's crude, not XLE energy. I figured doing this discussion this morning would be more useful than trying to go in and look at stocks or game out where we could go in the ES, because, I mean, like, well, when those numbers come out, it's all going to be a Bronco rodeo ride, right? There's no kind of gaming it out, anything before that. So we're looking at GLD. If we were to start making that move to the upside, we're getting a trend line breakover right now on a weekly chart. We could start to see, that slow move back up. And if you look at it from, say, an IBD perspective, where IBD talks about, double bottoms and things like that, they say a good double bottom should go lower than the previous bottom, right? And this is like a triple bottom at this point. But it's actually a good thing that it broke down below there first, because that's what traps traders and winds up all that energy, so that when we do break through, all those trapped traders are buying to get out, and their buying adds to the buying that was already happening, and then you get that big run up. Now, if you're trying to trade this from a technical analysis point of view, you don't yet have a valid trend. You would need a full set, 2 higher highs and 2 higher lows. If you don't wait for that and you get in early, there's nothing wrong with it. I'm certainly not the one to tell you to wait. You just wouldn't be getting in with a valid trend in place. And if you wait for a valid trend, you'd be waiting for a while, and you'd probably miss a lot of the move. Getting above 162.5 would be a good start. That is not, quote, a safe entry. You would actually need to get all the way above 168.5, which means you're sitting out for like another 10 points. And that is a hard thing to chew on right there, right? Why wait? Well, I mean, you can eliminate a lot of your risk that way if you wait for a pattern or a setup or a So I kind of like what IBD would call an early entry, getting it on the TRB, breaking above and closing above 161.62 on a weekly chart. To me, would be good enough. That would be a low risk, high probability entry. Because if you're wrong, it should not come back down below that level. And if it does, you kill the trade. Sure, you're going to have a little bit of a loss, but that's all it would be, a little bit of a loss. Losses are inevitable. You're going to take losses. You might as well make sure that they're little losses. And gold's down this morning, but not by much. We are IX10 now on gold, so we'll have to see how it works out. I'm going to continue to do this just because it fits into a paper and a video I'm making for you guys on gaps. But we had a gap here. We closed here. We opened here. That left this gap behind. The next day we gapped down. We closed up here, opened here, and we fell all the way down, and we closed that gap, and then we ran all the way back up. Gaps are awesome. So right now in gold, we have a gap up here that needs to be filled from where we closed to where we opened. So if we turn bullish today in gold, 160.7 would be my target. And just like we saw down here, it very likely won't go very far beyond that. And it could just run all the way up there and touch it and then run all the way back down again. So 160.7. That's what I got for you guys. Hey, have a good weekend. Be careful. Be safe. I will see you all next week.